It's a big week for Elon Musk. Tesla is hosting its long-awaited robotaxi event on Thursday. The build-up to the event has sent shares of the EV maker higher in recent weeks, following a general slowdown in EV demand seen earlier this year. Joining us now with his insights, we've got Ronald Jewsikow, who is the Director of Automotive Equity Research at Guggenheim Securities. Ron, great to have you on here with us. So, are you expecting a boom or bust when they make these announcements this week?
Yeah, I don't know if it's that binary, but we do expect it's more likely to be a sell the news event. I think there's been a lot of hype into this event. We've seen the stock move up. Investor expectations are quite high in terms of the promises that are going to be made at this event and the products that are going to be shown. So I think ultimately there are a lot of boxes that have to be checked, and we think that a real credible path to robotaxi commercialization in the next 12 to 24 months is extremely unlikely to come out of this event.
Ron, when you take into account how much has already been built into the price that we're seeing today, you mentioned so much of that hype. You mentioned the fact that investors have really been bidding this name up before the announcement. I'm curious, what do you think will be enough to trigger that sell-off? And you've got a price target of 153. I guess to what degree, or what is it going to be that really shifts investor sentiment to get us lower to that price?
Yeah, it's a good question, and one we're asked quite a bit. I think it's tough to have one catalyst that triggers, I think, our view towards the stock returning closer to what we think is fundamental value. But I would say that a business trading at 100 times earnings, 100 times our next year's earnings, with little to no free cash flow, is really difficult to underwrite without the robotaxi. So I think post this event, you do get a return to focusing on the fundamentals of the business, which remain quite poor. We estimate U.S. sales were down about 5% in the third quarter versus the second quarter. And while China growth was quite material in the third quarter, I guess we will see the quality of that growth once they report 3Q earnings with the gross margin line item. But it's tough to have any single catalyst from this point. But ultimately, even comparing Tesla to the other Mag 7 stocks, the free cash flow disparity is enormous, and the free cash flow yield disparity. So it's a really tough stock, I think, to underwrite fundamentally.
Ron, if we continue to see more consumer pressure right now, and especially as it translates through to auto purchases and the mindset there, what do you think that translates through for Tesla in the margins that investors have come to expect, especially even if they're adding on certain packages to their automotive experience? And what does this company need to do to ultimately generate demand for some of those more premium offerings?
Yeah, I think, for lack of a better term, I think the premium offerings are almost X growth at this point for Tesla. We've seen the Cybertruck grow, but it's largely been a function of cannibalizing Model S and X sales. If we just look at Tesla's sales volumes for premium vehicles, I think to see the gross margin inflection in the next 6 to 12 months is pretty unlikely. And I think it's important to know where we're coming from. Margins were 30% if we rewind the clock 2 years ago, gross margins. Today, we're sitting around 15%. So even if we marginally inflect higher, this is still a stock trading close to 100 times earnings. I think you need a material step function change, and there's nothing in the demand outlook that would support such a step function improvement in demand.